India buys 25% of global silver. Imports surge 129% and 20K gold calls. One country, quietly absorbing a quarter of the world's silver supply. And nobody is talking about it. 129% surge in a single year, while Goldman Sachs places gold at $5,400. And somewhere, in the shadows of Wall Street, someone just bet billions on gold reaching $20,000. This is not speculation. This is not a theory. These are the exact numbers from the exact data that the world's most powerful institutions do not want you to understand. Because when you do, everything changes. Everything. Welcome to Ag, where gold and silver speak louder than any headline ever could. Let's begin. India does not make noise when it moves. It simply moves. And right now, India is moving silver in quantities that should be making every economist, every banker, and every serious investor stop whatever they are doing and pay very close attention. Between April and December of 2025, India imported 184 million ounces of silver, 184 million ounces in just 9 months. Every year, the world's silver mines produce approximately 800 million ounces, and in just 9 months, one country absorbed 23% of that entire annual supply. That is the entire planet. Every mine, every country, every operation running at full capacity. Not 5%, not 10%, 23%. Compared to the same period the year before, India's silver imports surged by 129%. India more than doubled its silver imports in a single year. Now, serious analysts do not look at a number like this and move on. They ask one question: why? Because large moves in commodity markets do not happen randomly. They happen because something has changed, something fundamental. 184 million ounces, one country, 9 months. This is not a trend, this is a signal. And the question every serious business person must now ask themselves is simple: are they reading it? Numbers lie all the time, but every once in a while, a number arrives that cannot be manipulated. 129%, that is the surge in India's silver imports. For India to import 184 million ounces in 9 months, shipping routes had to be secured and storage prepared. This wasn't an impulse purchase, it was a coordinated operation. During this window, silver rose 46%. Normally, rising prices slow demand, but India accelerated. Buyers shifted from price sensitivity to supply anxiety. They are no longer asking how much it costs, they are asking if they can still get it. This is a confession that something has fundamentally changed. This is a nation making a calculated decision about where it stores its future, and the rest of the world has barely noticed. There is a rule in economics so fundamental, so universally accepted, that it is taught on the very first day of every economics class in every university on Earth. When prices go up, demand goes down. It is called the law of demand, and for centuries, it has held, until India decided it wasn't interested. Between April and December of 2025, something happened in the silver market that economists call a near impossibility. Price climbed 46%, and demand climbed 129% at the same time. In the same market, in the same 9-month window. This is not a rounding error. This is not a seasonal anomaly. This is a fundamental breakdown of one of economics' most sacred rules. And when sacred rules break, it means something beneath the surface has shifted. Something that no chart, no model, no algorithm was designed to capture. To understand what actually happened, one must stop thinking like an economist and start thinking like an Indian family. Consider a farmer in rural Maharashtra. He has worked his land for 30 years. He has watched governments change, currencies inflate, banks collapse. He has seen savings disappear overnight. He has seen neighbors lose everything they built across generations because they trusted paper, because they trusted promises, because they trusted systems that were not designed to protect people like him. And so when uncertainty arrives, he does not open a brokerage account. He does not call a financial advisor. He walks to the market and he buys silver, not because a chart told him to, not because an analyst recommended it, but because his father told him to, and his grandfather told his father. And somewhere across thousands of years of civilization, this knowledge was passed down like a quiet inheritance. Silver holds, everything else folds. This is what economists call price-inelastic demand. But that clinical phrase does not capture the full truth. Because this is not just inelastic demand, this is cultural memory activating at scale. Hundreds of millions of people simultaneously reaching the same conclusion. That the time to act is now. Not tomorrow, not after the next report. Now. And here is where it becomes deeply relevant for every business person watching this. When an entire nation shifts from price-conscious buying to supply-anxious buying, the market enters a different phase entirely. A phase where conventional analysis stops working. A phase where the old models produce the wrong answers. A phase where the only people positioned correctly are the ones who understood the shift before it was confirmed. India is not chasing silver. India is securing silver. There is a profound difference between those two things. And that difference is about to matter enormously. In the world of high finance, most institutions speak carefully. They hedge their language. They qualify their statements. They wrap their predictions in disclaimers so thick that by the time the average reader finishes, they have no idea what was actually said. So when Goldman Sachs, one of the most powerful financial institutions on the planet, raises its gold price forecast by 35% in a single move, from $4,000 to $5,400 per ounce, the serious analyst does not read the headline. The serious analyst reads what Goldman is not saying. Because Goldman Sachs does not make bold public forecasts for entertainment, they do not raise price targets to generate clicks. They manage trillions of dollars of capital. They sit inside the deepest rooms of global finance. They see data that never reaches public markets. They speak to people whose names never appear in newspapers. And when they move, they have already been positioned for months. The forecast of $5,400 is not the story. The phrase buried inside their report is the story. Significant upside risk. 4 words. In Goldman Sachs language, those 4 words carry enormous weight because they are telling their clients something they cannot say directly. They are saying, $5,400 may not be the ceiling. It may only be the floor. Now apply serious analytical thinking to what that actually means. If $5,400 is a conservative base case and significant upside risk exists beyond that, then Goldman's internal models are likely pricing scenarios at $6,000, $7,000, possibly higher. They simply cannot publish those numbers publicly without triggering the exact panic they are quietly preparing for. And here is where silver enters the equation with full force. Throughout modern financial history, silver has never moved independently of gold for long. When gold rises, silver follows. But silver does not merely follow. Silver amplifies. It moves faster, further, with greater velocity. If gold reaches $5,400 and the gold to silver ratio returns to its historical average of 60-1, silver sits at $90, which is almost exactly where it trades today, meaning silver is not overpriced. Silver is perfectly priced for $5,400 gold. And if Goldman's significant upside risk materializes, if gold moves towards $6,000, $7,000, silver does not double. Silver multiplies. Goldman Sachs just placed their hand on the table. They did it quietly, professionally, with careful language. But for those trained to read between the institutional lines, the message is unmistakable. The era of cheap gold is ending, and everything that moves with gold is about to move with considerably more force. The question is not whether Goldman is right. The question is far more urgent than that. When institutions of this size reposition, how much time does everyone else have before the window closes entirely? A specific kind of intelligence reveals itself only in the options market. Right now, institutions are buying massive $20,000 gold call options. With gold at $4,000, this 400% target isn't a gamble. It's asymmetric positioning, maximum potential gain for minimum upfront cost. This is institutional money hedging against systemic collapse and catastrophic dollar devaluation. This isn't a prediction, it's insurance. If gold reaches $20,000, the mathematical consequences for silver are staggering. It could surge past $500 per ounce. The $20,000 call is not a bet. It is a message written in the language of capital deployment. Something large is coming, and the world's most sophisticated minds are quietly preparing. China does not announce its intentions. It never has. While the Western world debates, discusses, and deliberates in public, China simply repositions, quietly, systematically, over years. And by the time the rest of the world notices, the move is already complete. Right now, China is in the middle of the most significant financial repositioning it has executed in nearly 2 decades, and almost nobody is framing it correctly. Start with the numbers. China's holdings of U.S. Treasury bonds have now fallen to $683 billion. That is the lowest level in 17 years. 17 years ago, China was still building its position in American debt. Now it is systematically dismantling it, month by month, quietly, without drama. To understand why this matters enormously, one must understand what U.S. Treasury bonds actually represent. They are not merely financial instruments, they are a statement of trust. When a nation holds U.S. Treasuries, it is saying, we believe in the stability of the American dollar. We believe in the integrity of the American financial system. We are willing to store our national wealth inside your currency. When a nation sells U.S. Treasuries, it is saying the opposite. Not loudly, not aggressively, but in the only language that carries real consequence, the language of capital withdrawal. And China is not merely selling, China is simultaneously buying gold every single month, adding to reserves with a consistency and discipline that speaks to a strategy decided at the highest levels of government. This is not a portfolio adjustment. This is a civilizational hedge. China is converting paper promises into physical metal, dollar-denominated debt, into an asset that has held value across every empire, every currency collapse, every financial system that ever rose and fell. But the silver dimension of China's strategy is the piece that has received almost no serious analytical attention, and it may be the most revealing piece of all. Recently, reports emerged from Chinese financial media that the Chinese government has begun compensating retail investors who suffered losses on silver-related investments. Small investors, ordinary citizens, people who placed modest amounts into silver financial products and found themselves on the wrong side of volatility. The government stepped in and gave them their money back. Now ask the question that every serious analyst must ask. Why would a government do that? Governments do not compensate retail investors out of generosity. They do it when the alternative is more costly. The alternative here is social unrest. Hundreds of millions of Chinese retail investors who feel betrayed by a market the government implicitly encouraged them to enter. That is not a financial problem. That is a political problem. And the Chinese Communist Party understands one thing above all else. Political problems must be neutralized before they grow. But there is a second layer beneath the political calculation. By stabilizing the silver market, by ensuring retail investors do not panic sell, China is preventing a massive outflow of physical silver from its domestic economy because China is the world's largest silver refiner. It controls critical portions of the global silver supply chain, and it has absolutely no intention of allowing that silver to leave. Read these two moves together: dumping U.S. treasuries, stabilizing domestic silver markets, and a picture emerges that is impossible to misread. China is not reacting to the global financial shift. China is engineering its position within it, storing gold, securing silver, abandoning paper, while the Western world continues debating whether any of this is really happening. History will record this moment, not as a trade war, not as a geopolitical rivalry, but as the moment one of the world's oldest civilizations decided it was done trusting someone else's currency with the storage of its future. Beneath every financial market lies a settlement mechanism. For silver, that's the COMEX, and right now, it's sitting on a fault line. There are 34,000 call options in the money, representing 170 million ounces of silver that holders can legally demand as physical delivery. But COMEX registered inventory stands at only 30 million ounces. That is not a gap, that is a 140 million ounce chasm. On February 27, 2026, contracts expire. This is the moment when paper promises must meet physical reality. Short sellers are forced to buy back, creating a mechanical feedback loop that pushes prices higher against a system that is already critically short. Silver lease rates at 20% aren't just a signal, they're a distress call. On February 27th, the COMEX fault line either holds or it fractures completely. There are moments in financial history that only become visible in retrospect. This is one of those moments. Right now, every force, every signal, and every structural pressure has arrived at the same place at the same time. India recently absorbed 23% of global silver production in just 9 months, a tectonic shift in supply. Goldman Sachs has raised its gold forecast to $5,400, repositioning private capital for systemic insurance. China has dropped its U.S. Treasury holdings to a 17-year low while quietly accumulating gold every single month. When physical commodities decouple from paper markets, conventional wealth becomes dangerously exposed to systemic pressure. The only question that remains is deceptively simple, and yet the most consequential. Have you read the signals? Because the convergence point does not wait. The window is closing. This has been OW and AG.